Come our market guest, we have Hemang Jani who joins us, as well as Richard Harris, Executive Director of Port Shelter, who joins in on the show. Hi, gentlemen. Thanks a lot for joining in. Well, Richard, I'm coming across to you first. You know, the FIs have gradually returned to the Indian markets in the last month or so. Because of the ongoing geopolitical situation here in India on the borders, do you think that will deter FIs? I was looking at past instances where we have seen some of these skirmishes on the border, and it didn't really deter foreign investors at that point of time. But your take?
Yeah, I think we have to separate politics from economics. And, we all know the phrase, it's the economy stupid. And now I'm not talking to you, of course. But it's really the economy drives these things. So if a skirmish is unlikely to affect markets in general, then markets will largely ride through it. I mean, you can see what's happened basically with a major war in Ukraine, major wars in the Middle East, and the markets have generally not really moved. And indeed, even with threats we're seeing to Europe, we're actually seeing the markets move because Europe clearly has to spend more on defense. So I think that as things stand at the moment, these are skirmishes. They are unlikely to affect economies in general, and that's really what investors focus on.
Okay, all right. So unlikely. Economics more important than these, occasional political issues that do take place, geopolitical issues. But Richard, India trades at a big premium in comparison to most global markets, particularly the emerging market basket. Do you think, there's a reason that we could see some kind of trimming off from that because of this?
Well, we have seen the market perform less well than it has in the past, but you have to be careful about comparing it to, say, an EM basket, because most EM countries are so different. And, of course, China is a very large component of that, and China's gone through, 5-6 years of underperformance. So, yes, technically it looks very cheap on that basis. I think that people will look at valuations as they are now and mark them as they are now. It seems to me to be clear that the Chinese market, even though it's under threat from tariffs, is likely to remain the one to watch, partly because it's done so badly and partly because the authorities are putting a lot of stimulus into that market.
Right, got that, Richard. What's the sense on India? Like you said, it's all about the economy is stupid, but for the timing, there's a lot of uncertainty. And there was global uncertainty just as that was settling, which, by the way, still hasn't. We don't know the eventual contours of the deals that China will strike, or we will strike, for that matter, with the US. Amidst all of this, next 6 months, what would you be doing with the India market?
Well, I think, obviously, India is going to be quite sensitive to what happens in the rest of the world. My analysis at the moment is that markets in the short term will probably do quite well. And you may say, why is that? And that's because Trump, of course, came up with some really big threats to trade globally. And the markets priced themselves downwards quite substantially. Now what we're seeing is little pieces of good news. I don't think this is a strategy, by the way. I think it's just how it's worked out. We're seeing little pieces of good news. UK trade deal with India, UK trade deal with America. Then we'll see trade deals with Europe and the US, and trade deal maybe with China and the US. So we'll have all these little pieces of good news. But we're still in a position that the supply chains have been seriously damaged, that we won't see tariffs go down to what we had before. So I think in the shorter term, markets will take some encouragement from little pieces of good news. In the long term, there's an obsession with recession. We have to be very concerned that supply chains have been very seriously damaged, that inflation will go up sharply in the States, that these tariffs will have an impact. They already have had an impact. So the tariff story at the moment might be actually quite a good one, but the really big story looking further out is the possibility of recession.
Okay, absolutely. I think lots of different brokers, banks are still calling that out. That's what Jahangir Aziz of JP Morgan told us, that they are expecting recession in the second half. By the way, for us here, the mid-cap index has turned into the green for what it's worth. There's a little bit of buying. A lot of individual names, and particularly any of the companies that are linked with defense, they are doing very well this afternoon. Richard, thank you very much for joining in and giving us that perspective. Really appreciate it this afternoon. Thank you. All right. Well, with that, let's move on to Hemang Jani, who's been waiting by patiently. Hemang, thank you for being with us. It's been a tough last many hours, but I mean, less tough for us, far tougher for those who are actually at the borders. What would you, I mean, just let's start with basic advice. Till this settles, we have full clarity, hopefully by next week. What would your suggestion or advice be for investors?
Surabhi, in fact, 2025 has begun with a lot of turbulence, and it seems, that it's been a never-ending kind of a ride or a grind that we are seeing. But the good part about this whole saga is that despite the volatility, whether it's the current situation that we are going through at the border, war with Pakistan. We had this Trump tariff-related things, but the market, by and large, remained quite okay. We had a very smart bounce back. So I do think that, when the mid-caps and the small-cap stocks, which have underperformed in the last, let's say, about, 1 month and the last leg of rally, I think, this weakness would provide a good entry point. And definitely, we would be more positive and inclined towards, those smaller and mid-cap themes versus the large-cap ones.
All right. Hi, Hemang. Good afternoon and good to see you, Ben. Hemang, let's talk stock specific. I recall one of those auto hangs that you liked in the past was SGS, if I'm not mistaken. The stock is up close to around 10% today. The con call, I believe, was fairly good. They've penetrated into a couple of new clients. If you want to talk about that or any other auto ancillary stock.
So yes, SGS Enterprise is something that we are covering. We have been liking that stock. And while the company announced the numbers were reasonably okay. But I think what stood out was that they penetrated into Hero Motors and they have managed to get order of almost about 80 crore. Now, this company has a total turnover of about 750, 80 crore. So almost 12% of the business would come from Hero. And it's a marquee account which they were trying to get for a long time. So I do think that this could be a big, re-rating trigger for the stock. Anyway, it's not a very expensive stock, about 12 or 13 times the next year. Means a company growing at about 22, 23%. So definitely a positive view out there.
All right. Thanks a lot, Hemang, for joining in and talking about a couple of stocks. A short but effective chat. We look forward to seeing you next week. For the time being, we slip into a short break. You come back, we'll continue our focus on markets as well as on stocks.